What's up, guys? Welcome back to the channel. So today is episode 111, and today we're going to talk about something that has been very controversial for a while now. I get questions on this, I would say almost on a weekly basis, and the topic is dividend investing a scam? Meaning, are you placing the bulk of your cash into an underlying asset that's barely moving in overall value and being compensated with a very small percentile in terms of dividend returns? And does this work for the retail investor versus, say, the institutional investor that has a larger capital base, which stands to gain significantly more by investing into dividend stocks? So we're going to go ahead and take a look at this controversial topic today. We're pretty much going to be using two main companies for comparison, which is going to be Coca-Cola, right? Ticker symbol KO, versus Google. All right. But we're also going to throw the legendary investor Warren Buffett into the mix, and we'll get his take on the whole dividend investing scenario. Let's get right to it. So up on the screen, as you guys can see, I have Coca-Cola pulled up, which is KO. All right. So over max time, Coca-Cola has returned 117% for its investors over max time. So if we go all the way back to Robinhood here, Robinhood usually probably doesn't go back anywhere past the 2000 mark, but goes all the way back to 2000, all right, to where it is now, which is, around 60, 60, 61, $62, and it's been going this way for a while. Looking at this chart immediately, I can tell you something. There's a lot of people making money playing leaps on this. You see these wide dips? Bam, 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 just constantly. If you're playing leaps, all you got to do is get in here. And then, just look at these wide dips. But that's what it looks like to me from this end. All right. So the reason we're choosing Coca-Cola is, I would say, one of like the dividend staples. Yes, there's a bunch of them. Coca-Cola is probably the most popular one, and it's probably made popular by Warren Buffett. It's made popular by Warren Buffett because I believe Warren Buffett has roughly about 400 million shares of Coca-Cola, which pretty much damn near makes him own the company, pretty much. So it's heavy on a lot of the dividend investors' radar. So most people usually try to get this stock. Another factor is also the bar to entry. It's very low. It's not as expensive as, say, like its counterpart like Pepsi, which Pepsi I believe is like in $100 range. Let's go ahead and just take a look at that real quick. All right. So Pepsi is, what is Pepsi? Yeah, 177. Another popular one, Johnson & Johnson, J&J. This is another popular dividend stock. Johnson & Johnson, this one's 147. So as you guys see, the bar to entry on KO, Coca-Cola, is a lot easier because, it's a lower price stock. It's easier to buy one share of this. One share of Johnson & Johnson could almost buy 3 shares of Coca-Cola. All right. And do also remember, guys, that we have fractional shares available to us now as retail investors. So, you can also leverage that as well to get into this stock. All right. So now what I want to do is I want to go ahead and pull up Coca-Cola, and we're going to go ahead and take a look at it on Yahoo Finance. And what I want to show you guys is, and I did a reel about this probably like about a year ago, which you guys could take a look at. I'll put it up on the screen now, but it kind of just gives a breakdown of how these large institutions make a bunch of money from dividends playing stocks like Coca-Cola, and pretty much just tells you, hey, this is what they're doing with your money when you leave it in the bank. All right, so here we have Yahoo Finance, all right, and we have Coca-Cola pulled up. So ticker symbol KO. And what we're going to do is on the left here, there's a section here that says holders. And if we go ahead and click on that, what it does, it just brings up the major holders. All right. And then it tells you here the top institutional holders, which is what we want to take a look at here. So we do see that Berkshire Hathaway, which is Warren Buffett's company, owns 400 million shares. All right. And this was most recently reported on March 31st of 2024. All right. Vanguard Group is next with 300 and almost 70 million shares. BlackRock, State Street Capital, Geota Capital. Now, none of these companies, retail investors like me or you, we don't put our money into this. These are not necessarily banking companies per se. So let's go all the way down to a popular bank, JP Morgan Chase. All right, so this is Chase Bank. Chase Bank owns 61.57 million shares of Coca-Cola. 61.57 million shares. Now, Coca-Cola pays a dividend. Let's take a look and see what that is. Coca-Cola pays a dividend of $1.94 per share, right? The Coca-Cola company pays an annualized dividend of $1.94 per share with a forward yield of 3%. So you're getting 3%, all right? $1.94. Now, $1.94, let's say we just round it up to $2 and, call it, they pay a dividend every 3 months or 4 times a year. Let's call it 50 cents a share. We go back over here to Yahoo Finance, right? And we go ahead and we take the look at JP Morgan Chase. Let's pull up some numbers. 61.57 million shares. They're getting 50 cents for every share that they own, right? Roughly 50 cents. I'd say it's probably like 40 something cents, high 40s per share, right? So let's go ahead now and multiply that by 61,570,000 shares. We're looking at 30,785,000 that's paid out to this company. Are you guys listening? It's paid out to this company every 3 months. That's what the bank's doing with your money. The bank's playing the dividend game, and that's what they're doing with your money. All right. But it ain't just the banks. It's these big hedge funds, these holding companies, because that's what Berkshire Hathaway is. It's a holding company. We have Vanguard, BlackRock, State Street Corporation, and Morgan Stanley. List just goes on. T. Rowe Price. All right. So these guys are making a ton of money playing the dividend game, right? Now, when you take a look at a stock like Coca-Cola, the stock doesn't really move that much. So for the average retail investor, putting your money into this stock, for me, I own some shares of it. Don't get me wrong, but it's not a priority for me in terms of long-term investing, because yes, the dividend is a decent dividend. But then when you look at the overall growth of the company, so let's look at it year to date. Year to date, it's up, what is that? 5%. Past year, it is up 2.53%. All right. And then over max time, as you guys know, it's up 117%. So during this time frame, right, if you had your money into this stock, it would have grown 2.5% over the year. And then they would have given you a dividend yield of like, what is that, 3%? Let's go back to that real quick. Yeah, 3.11%. So now you got to ask yourself, let's say that's, let's say it's 6%, all right, for the year. You got to ask yourself, am I able to get more on this capital that I would be pouring into Coca-Cola by investing into, say, another solid company. Granted, Coca-Cola is a very solid company. They've been around for decades, you know. So they've been around. They've proven, time tested, just like Johnson and Johnson and all the other dividend companies. But here's something that most of these guys that are really like gung ho and super happy about pushing this whole dividend, investing thing and the whole fire community stuff, what they don't tell you is a lot of these companies, when they start paying a dividend, it's primarily because they're tapped out in terms of growth. The company ain't really going anywhere. They're not really innovating. They're not really coming up with anything new or spectacular. Probably an advertising budget. They might buy new equipment every couple of decades or something like that. I'm pretty sure the way Coke was made 40 years ago, it's pretty much how it's made now. What's probably changed slightly is like the packaging. Back in the 80s, they used to have the glass bottles, and they switched down to the cans. Now it's plastic bottles and cans. So not much innovation going in there. And that's why they return a lot of that cash flow back to investors in the form of dividends. So you get, like in this case, you're getting 3%, but you're missing out on a whole lot of growth if you were invested in another company. So now I want to go ahead and pull up Google. All right, so let's go to Google. Google. So we have two here listed on Robinhood. We have the Class A, Class C. Doesn't really matter. We look at Google year to date. Google is up 26%. Google is up 26%. So if you had put that same money that you would put into Coca-Cola and Google, you would have been up 20 points. All right. In addition to that, Google recently announced that they're going to start paying a dividend. All right. Let's look at it last year, 40%. Let's go to Max Time versus Coca-Cola, 6,874%. This is why I'm big on tech. Now, yes, tech has gone through years of a couple years of like rough spots, but tech is always going to be tech, man. And tech is, exactly what it does. It booms. You could look at SPY as ETFs. You could look at QQQ. QQQ is a monster. SPY moves too because it's the overall market. But when QQQ is moving, man, does that thing move. It's a monster. That's because it's rooted in tech. And technology is always changing. It's always advancing. These companies like Google, they acquire companies. Oh, we don't have the technology? Let's buy them out. Oh, we're not selling. Shut up. Everybody has a price. Oh, we're not selling. 2 million. No. 100 million. No. 5 billion. What? With a B? Yes, 5 billion. Where do we sign? They have the money to do that. Google is cash heavy. Google makes, I would say, probably 90% of their revenue from advertising, meaning they create software that interacts with users, put it out there, and the software just pretty much runs itself. Just look at YouTube. Google ain't making no content. They're not spending no money to make no videos or movies. No, they put it out there. You make the videos, you make the content, and they make money from it, and they give you some money off it too, 100%. But just look at the effort. Minimal. They just have to focus on innovation. All right. And that's why for me, I'm not saying that dividend stocks are a scam. To some people, it is, but for me, there's a reason why I would probably say about 70% of my portfolio in tech, because it just grows so fast. So let's go ahead and take a look at this article from CNN where they kind of break down what's going on with these tech stocks lately and why now they're making a move to provide a dividend. All right, so this article says here, Google parent company, and this is from CNET, actually, not CNN, CNET, which is a reputable tech source. Google parent company issues first dividend What to know and why this matters. The move by Alphabet comes just months after Facebook and Instagram parent Meta issued its own first dividend. All right, so let's go ahead and just go into this article here. All right, so it says Google parent company Alphabet said Thursday that it would issue its first ever dividend to shareholders. The dividend is just 20 cents a share, but it was notable as the first time event. In addition to investors receiving a dividend, Google's co-founders Sergey Brin and Larry Page will receive a dividend of $146 million and $78 million respectively. Since its founding in 1998, Google has returned money to its investors through outsized performance and growth in the stock price. You hear that? Outsized performance and growth in its stock price. That's where the money is, guys. Not chasing that 3.11% or whatever that is. You know, you could do that if you want to. It's going to take you forever, but you could do that. But this right here, this is the money. Outsized performance and growth in its stock price. But now it's changing things up. And in doing so, it's looking like more mature companies in other industries. Notice the phrase here, mature companies. Mature just means old. You know, these old companies that have run out of products, run out of innovation, run out of tricks. Pepsi, they're not going anywhere. Look at Pepsi. It's Pepsi. They have chips, they have blah, 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 but it's capped out. Same thing with KO, Coca-Cola. What else are they going to come up with? Innovation stops there. Johnson & Johnson, pretty much kind of the same thing. Kind of. And I say kind of because Johnson & Johnson is also into health, you know, which there's room for a lot more innovation there, you know. What else can you do with the Coke? They don't have about 30 different flavors, cherry, this, pineapple, Coke, all kind of craziness. It's still Coke. And the original is probably what's selling better than anything else. All right, so now this article says, why does dividends matter? All right, so dividends act as an important tool in the corporate world, allowing investors in a company to generate cash from their investments without needing to sell shares. Dividends are often used as a signal to Wall Street that a company is performing well, has cash to burn, and wants to share that value with investors. All right, just like it says here, dividends is a way for you to invest into the company, get some residual income, and not sell your shares. That sounds real good. And that in itself, as a concept, sounds really good. My problem comes when the company is not moving. When the overall stock price is not moving and you're giving me 3% return on my money a year, when I could get, what is that, 40% investing in Google? Year to date, 26% investing in Google. So you do see the problem there, guys. Now, the next article I want to show you is an article from, what is he called? Probably one of the greatest investors of our time, Mr. Warren Buffett. All right. And this talks about why his company, all right, so let's pull it up right here. His company, all right, Berkshire Hathaway. As you see, they have two different ones. We'll just choose A. Look at the stock price, $615,285 a share. Just bananas. Look at the growth over time, 1,078%. All right. So this is Warren Buffett's company, the greatest dividend investor of all time. He's a good value investor. That's what he is. But, the dividend people will tell you that. But this article, in a nutshell, is going to explain to you why Warren Buffett, his company, Berkshire Hathaway, does not pay a dividend. All right. So this article is from Wealth Advisor. And it says here, why doesn't Berkshire Hathaway pay a dividend? All right. So it says here, in its 2022 annual report, Berkshire Hathaway reported a net loss of $22.8 billion. and a 125 billion cash pile. All right, so they're just sitting on money, right? Excess money. They could pay a dividend. Once again, the question will be asked, why doesn't Berkshire Hathaway pay a dividends to its shareholders? The short answer is that the company founder and CEO Warren Buffett believes that the money can be spent in other ways, which makes sense. Which makes sense. This is exactly why tech companies traditionally don't pay a dividend. Now, Microsoft, for example, has been paying a dividend, I believe, since 2003. It's a very small dividend, but they've been paying a dividend. So they were one of the first tech companies. And when I say tech, I mean like really innovative. Yes, Apple has been paying a dividend since, I think, 1987. I have my reservation about how innovative Apple is. They find a product. That's my take on Apple. They find a product, they run with it, and they just ride that till, the sun comes up. You know what I'm saying? That to me is not really innovation. But as you guys can see, there's a push now amongst a lot of the dividend companies to kind of, amongst a lot of the tech companies to sweeten the deal. You get that crazy growth in the actual underlying stock price, and they're giving you a little something on the side in terms of dividends, which to me now just makes these companies like KO and Johnson and Johnson and Pepsi they look less attractive now, to be honestly, to me. All right. It says here, key takeaways. Berkshire Hathaway is a large, diversified holding company led by renowned investor Warren Buffett that invests in insurance, private equity, real estate, food, apparel, and utility sectors. Despite being a large, mature, and stable company, Berkshire Hathaway does not pay dividends to its investors. Instead, the company chooses to reinvest retained earnings into new projects, investments, and acquisitions, which makes sense because when you do that, the overall stock price is going to grow. All right. So this is what was funny. And I'll go more into exactly what he said. He said this on a video, but this part was actually funny. It says, despite the company having a record amount of cash on hand, the prospect of Berkshire Hathaway dividend is dim as long as Buffett is in charge. The company has paid only one dividend in 1967, and Buffett later joked that he must have been in the bathroom when that decision was made. He's not paying any money. And there was an interview I watched with him, and when they asked him about it, he said, "Listen, man, if you really think about it, if I was to say pay a 3 or a 2% dividend, right? But then that would limit the growth of the company, and then the stock could grow. Let's say, what is this? 26% within a year. You would be leaving what? 23% on the table? You'd be leaving money on the table because that money, that growth, that 1 year growth that you see from Berkshire Hathaway comes from taking the excess cash and reinvesting that into new ventures to grow the underlying stock price. All right. And that's why, to me, like I said, I just think it's kind of crazy. I really think it's kind of crazy. Now, when we go back to the CNN, the CNET article, I don't know why I keep calling it CNN, but if we go back to that CNET article, it says here, a new trend for the tech industry. So why is Google suddenly having a change of heart? The company didn't say, but it may be following the crowd. In February, Meta announced its fourth quarter and full year earnings for 2023, and it said it would offer its first ever dividend to investors. That dividend, 50 cents a share, will help Facebook co-founder and Meta CEO Mark Zuckerberg net $700 million this year alone, if Meta follows through with its plan to pay 4 quarterly dividends. To be sure, dividends have been universally avoided by tech companies. Microsoft issued its first dividend in 2003, nearly 30 years after its founding, and has consistently issued quarterly dividends to shareholders since 2013. Apple issued its first quarterly dividend in 1987 and has spent the last decade using quarterly dividends to return cash to its investors. All right. So it says here, to be sure, dividends have been universally avoided by tech companies. And this is exactly why. Tech companies like Google need funds on hand for research and development. They also need funds to acquire new companies, new startups, new innovative companies that are making a wave and making an impact. When you have cash on hand, you have options. You could buy the company. They acquired YouTube. Look at that. Imagine if they didn't buy YouTube. Look how much money YouTube is bringing in for Google right now. So when you have cash on hand to invest in new projects and to push innovation, the underlying stock price, I'm sorry, it's only gonna go up. It's only gonna go up. And in the long term, it's gonna outweigh any kind of gains, dwarf any kind of gains that you would get from a measly 2, 3, or even a 5% dividend. Because if you look traditionally at these companies like KO, Coca-Cola, they've been stagnant. They haven't really been growing. That stock price has been floating around $60 forever. Doesn't really go anywhere. You look at Google, right? 1 week, it is down 1%. Look at it over a month, 13%. It made a 13% move in 1 month when Coca-Cola made a 2.13% move the entire year. For me, it's a no-brainer, guys. But, you guys can make your own decision. I do have one concept, and that is always to be wary of anything that the masses tend to embrace or they tend to push. Just be very careful. Just like the old saying is, be fearful when others are greedy. All right? But that's it for the video today, guys. I hope you found this information useful. If you did, please consider subscribing. I make new videos like this every day. Go ahead and like this video and also share it with a family member or a friend. Towards the end of the video, you will see cards pop up with some of my most popular videos. On the left, there'll be one that tells you pretty much how you could get to your first 100,000 long-term investing. And then to the top right, there'll be another one which just gives you an introduction to trading options on Robinhood. And as you guys know, I use options, the profits from options, as a way to grow my long-term investing account. Y'all stay safe and have a blessed day. Peace.